Right now, somewhere in Australia, thousands of people are about to make a mistake that will cost them thousands of dollars. Not because they're careless, not because they don't care about their future, but because the 30th of June is creeping closer and most of them have no idea there's a simple legal strategy sitting right in front of them that could cut their tax bill and boost their retirement savings at the same time. The worst part? Most will never even know they missed it. Stay with me, because by the end of this video, you'll know exactly what to do before the financial year ends. Let's be honest, most Australians are doing the right thing. You work hard, you pay your tax, your employer dumps money into your super fund every single fortnight. And that's great, really. But here's the thing, the system actually gives you more tools than most people realize. There's a legal way to put extra money into your super, claim a tax deduction for it, and potentially reduce what you pay the taxman. And no, this isn't some loophole or dodgy trick. It's built into the rules. The problem is, most Aussies never hear about it. It hardly ever gets explained simply. So year after year, they leave money on the table simply because nobody sat them down and said, hey, did you know you can do this? Okay, let's break it down in plain English. When you put money into your super fund, there are two main types of contributions. There's the money your employer chips in, that's called your concessional contribution, because it's taxed at a lower rate before it hits your super. And there's money you choose to add yourself. Now, here's where it gets interesting. If you put extra money into your super from own pocket, and I'm talking about money that's already been taxed, like money from your after-tax pay, you can actually claim a tax deduction for it. This is called a personal concessional contribution. Think of it like this. You pay tax on your income, then you decide to take some of that after-tax money and pop it into your super. The government basically says, okay, we'll treat that as if it never got taxed in the first place and give you a deduction. The key is you need to tell your super fund you intend to claim that deduction using something called a notice of intent to claim a deduction. And here's the part most people completely miss. The deadline matters big time. Let me give you a simple example using easy numbers. Say you earn $80,000 a year. You're already paying tax on every dollar. But let's say you decide to put an extra $5,000 of your own money into your super and claim it as a tax deduction. Your taxable income would drop from $80,000 to $75,000. Now, depending on where you sit in the tax brackets, that $5,000 reduction could mean you pay somewhere between roughly $1,000 and $1,700 less in tax. In short, you could potentially get hundreds of dollars back while also boosting your retirement balance. It's not a guarantee. It depends on your exact income and circumstances. But this is how the math works for a lot of everyday Aussies. Now, who might benefit from this? Here's the quick rundown. If you're an employee who's been working hard and you've got some savings sitting in a regular bank account earning almost nothing, this could be worth looking into. If you're self-employed and you don't have an employer dumping money into super for you, this is especially relevant. You're responsible for your own retirement, and this strategy could help you catch up. If you've had a higher taxable income this financial year, maybe you picked up extra shifts, finished a big project, or got a bonus, you might have more room in your concessional contribution cap than usual. If you're a few years away from retirement and you want to pour more into your super while reducing your tax, this could be a smart move. And if you've got unused cap space, meaning you didn't max out your concessional contribution limit in previous years, You might be able to carry it forward and use it now. This is where Australians often get caught. The financial year finishes on the 30th of June, not the 1st of July, not whenever you get around to it, the 30th of June. And it's not about when you send the money. It's about when your super fund receives it. If you transfer money on the afternoon of the 30th of June, but the fund doesn't process it until the 1st of July, it counts for the new financial year, not the one that's ending. That could change everything because contribution caps and tax deductions operate year by year. So if you're planning to do this, don't wait until the last minute. Give yourself a few days buffer. This is one of those times when being early actually matters. Let me walk you through the biggest mistakes I see people make. Mistake 1, waiting until the final day. Don't do it. Give yourself at least a week. Life happens. Banks close on weekends. Payments can take 24 to 48 hours to process. If you send it on the 29th of June and it arrives on the 1st of July through some delay, you've missed the window. Mistake 2, exceeding your contribution cap. There is a limit to how much you can put in as a concessional contribution each year. Go over it and you could cop extra tax. Not fun. Check the cap before you act. Mistake 3, forgetting the notice of intent. If you don't tell your super fund you want to claim a deduction, you won't get it. Simple as that. This form is essential. Don't skip it. Mistake 4, confusing salary sacrifice with personal deductible contributions. They sound similar, but they work differently. Salary sacrifice comes out of your pre-tax pay before tax is calculated. Personal deductible contributions come from after-tax money. They're both useful, but they're not the same thing. Don't mix them up. Mistake 5, not checking your super balance or cap limits. Before you do anything, know where you stand. Log into your super fund's online portal or app. Check your contributions for the year. Know your cap. Know your balance. Mistake 6, not keeping enough cash for daily life. This is the big one. Money you put into super is locked away. You generally can't touch it until you retire, meet a condition of release or hit preservation age. Do not contribute money you might need next month, next year, or even in 5 years. This strategy only works if you're certain you won't need that cash anytime soon. I need to be really clear here. This strategy is not for everyone. Superannuation is a long-term game. The money inside usually stays locked away until you hit preservation age, currently somewhere between 60 and 65, depending on when you were born. If you're young, if you're self-employed with irregular income, or if you might need that money for a house deposit, an emergency, or something else, stop. Think carefully. Don't sacrifice your flexibility for a tax deduction. It's not worth it if it leaves you stressed or stuck. Alright, let's make this practical. Here's your simple checklist before the 30th of June. First, check your concessional contribution cap. Log into your MyGov account or your Superfunds app. Find out how much room you have left for this financial year. Second, check your current super contributions. Add up what your employer has already put in, plus anything you've added. Do the math. Third, check your cash flow. Make sure you have money you genuinely won't need for at least a few years. Fourth, contact your super fund. Ask them how to make a personal deductible contribution and get the right forms. Fifth, submit the notice of intent. This is the form that tells the fund you want to claim a tax deduction. Do not skip this step. Sixth, speak with a tax professional or a licensed financial advisor before you claim. Get it done properly. Here's the bottom line. This is not about getting rich quickly. This is not about some secret hack that makes you wealthy overnight. This is about understanding the rules that already exist, using them properly, and avoiding a common mistake that costs Aussies thousands every single year. If you've got extra savings, a decent income, and you're confident you won't need that money for a while, this could be a genuine opportunity to reduce your tax and boost your retirement fund at the same time. But only if you do it right, before the 30th of June, and only if it makes sense for your situation. If this helped you understand superannuation a little better, hit that like button. If you want more simple Aussie money rules explained without the confusion, subscribe to Simple Money Aussie with Rafiki. Hit the bell so you never miss an episode. And drop a comment below with the word super if you want me to break down more strategies like this in plain English. Before I wrap up, a quick reminder: I am not a licensed financial advisor or a tax professional. Everything in this video is for general information only and should not be taken as personal financial advice. Your situation is unique. The rules can change and they apply differently depending on your circumstances. Please speak with a licensed financial advisor or a qualified tax professional before you make any decisions about your super or your tax. Look after yourself and look after your money. Thanks for watching. I'll see you in the next one.